Hello everyone. The topic we are going to discuss today is bond yield. So what you will learn from this bond yield, let me summarize fast. You will get to learn about what is a bond, what is its yield, how is it relevant to you as an investor, how bond yields are important for understanding your home loan interest rates, again how bond yields are relevant to gauge the economic health of a country, and how the central banks use bond yields as a measure to building their monetary policy, which will eventually impact your investment portfolio. And last of all, you as an investor, should you be investing in bonds? And if you are investing in bonds, what all things you should look at before investing into it? So let's get into the topic. So first of all, what is a bond yield? So bond yield is nothing but a annualized return an investor who invests in that bond gets by holding the bond till its maturity. The maturity of a bond can be as long as 2 years to 30 years. Normally, 2 to 10 years bonds are named as notes. Now, what is face value of a bond? It's the cost of the bond when it's first created, and that's the same amount you will get once the bond matures. Basically, the amount guaranteed to you at the end of the maturity date of that particular bond. Say 10 years means at the end of 10 years, you get that particular amount. Say it's a 1000 rupees bond. Then if you are completing, say 10 years, that bond period, maturity period, then at the end of the 10th year, you will get 1000 rupees back. Another important point is coupon rate, otherwise called annual interest rate. So say you are investing 1000 rupees in a bond and the maturity period of that bond is 10 years. And you are promised a coupon rate, which is the yield which you get out of that stock in the form of dividend, say 5%. So 5% yield on 1000 rupees means you get 50 rupees. So 50 rupees is the bond yield you get every year for the next 10 years. If you are invested in the 1000 rupees 10 years bond, 50 rupees on year 1, year 2, year 3, till that 10th year you will get 50 rupees, and at the end of the 10th year you will get 1000 rupees back, which is your initial investment for the bond. So basically, bonds are released by governments and even corporate firms so that they fund their cash requirement, upfront cash requirement. Say they want to make an infrastructure facility, say roads. So for constructing that road, they need, say, a large ring road in a major city. So they will require money for that. So for that, funding that capex requirement, they will release bonds. So bonds means this can be for roads and infra, they go with InvIT, infrastructure trusts. But then if they want to fund facilities like, say, various schemes for education or then health and other facilities for common people, they require money. So for that, they want cash. For getting upfront cash, they will float this bond and they will tell that if you give me 1000 rupees upfront, I will give you 50 rupees every year till the 10th year, and that 1000 rupees they will collect from various people, and that consolidated amount they will use for funding their capex requirement. So this is how the bond works in very simple terms. But then another important thing here is that if the economy of that country, say India I am talking, so India is having a good economic condition, so the stock market also will be very attractive. So if the stock market is doing good and if you are getting better returns from stock market, then the bonds will be less attractive. So there will be lesser demand for buying the bonds, because bonds are getting somewhere around 5 to 6% maximum yields, 6.5 these days. So this is much lesser compared to 15 to 20% returns from stock market. So in that case, the bond becomes less attractive. So to make it more attractive, what we have to do, the government increases the bond yield, means the interest rate on that particular bond. Instead of 5%, he'll tell I'll give 5.5% or 6%. So if the bond yields increases, then the investors will decide that, say, anyhow the bond is safe security, government will not become default, so you will get the amount at the end of 10 years or 5 years, whatever the tenure be, and you will consistently get a cash flow from the bond yields as well, based on the coupon rate which is agreed with you, say 6%. So he will invest in bonds, and that particular amount, 1000 rupees, which was supposed to invest in stocks, goes to the bonds. So this is how it works. But on the other side, if the economy is doing well, then the people have more spending, the inflation goes up, because there is a lot of income available for them. As the economy is doing well, the consumption theme also increases. So there is more spending by people, and to curb down the inflation, because if inflation goes high, it is bad for the economy. So to bring down the inflation, what RBI does, or well, in that case, the central bank of a country does, he will increase the interest rate. So if the interest rate increases, then the fixed income returns like FD rates, your FD rate increases. So FD rate increases means people will move money more into FD rather than risky investments like stocks or even in that case bonds. So if the FD rate increases, if the interest rate increases, so interest rate is nothing but the repo rate for in case of RBI, wherein they increase the repo rate means the amount, the rate at which the central bank RBI is lending the money to the commercial banks, say SBI or SGFC. Then SGFC keeps a spread, say 2.5% on that repo rate. Say currently it is 5.5% repo rate means they will add some 2.5%. So 5.5 plus 2.5 means 8%. So they will lend the money at 8%, say your home loan, to retail people like me. So they will get a spread of 2.5% and they will give 5%, 5.5% repo rate interest rate to RBI. So that's how the interest rate works. So if the interest rates RBI increases, that ripple effect will come to me as well as my cost of borrowing increases. But my FD rates become more attractive because the interest rate increases. So FD rate increases, so people will not invest in bonds. So for people to invest in bonds, because government needs money, right? So to invest in bonds, they will increase the interest rate of the, coupon rate of the bonds as well to match with the FD rates. So the new bonds which they are releasing, they will give it at higher rates. Say 1000 rupees I have taken bond at a yield of 5% and I am getting 50 rupees every year for next 10 years. And in the first year, the economy was going good, interest rates went up. So for more fund to get into the bonds, because government wanted more money, the new bonds will be issued at higher rate, higher coupon rate, higher bond yield, which means at 6% they are bringing the new bonds. So the old bonds which I am holding 5% becomes less attractive. So what happens? As the demand goes down for the bonds, the 1000 rupees which I am holding will go down to 950 rupees, say. So this is traded in open market. So demand goes low, just like stocks and other commodities, 1000 rupees become 950 rupees. But my coupon rate is fixed, like 5% yield is been guaranteed to me on the earlier 1000 rupees. But the rate went down to 950 rupees means I am still getting 50 rupees, which is 5% of 1000 rupees as a coupon rate for next 10 years. So 50 rupees upon 950 means the yield increases. It's not 5%. It is more than 5%. So as the new bonds are released at higher yields, the existing bonds value become lower and their yield becomes higher. So now you got the relation between the interest rate and the bond yield. So yield higher means the base rate of the bond and the interest which is originally guaranteed on that. So that interest remains same, the rate remains same, but the bond value goes down means the returns from that bond. Like the second, I have bought it at 1000 rupees, but I am selling it in the market at 950 rupees. So the person buying at 950 rupees still will get more percent than me, because 5% on 1000 rupees, which is 50 rupees, on 1000 rupees is less compared to 50 rupees on 950 rupees. His initial investment is 50 rupees less, so his returns are higher. So as the interest rate goes high, the existing bond yields increases because the bond value reduces. So that's why I always tell that the 10-year, that is the long-term bond yields, are always a proxy for your going forward home loan interest rate. So hope you understand the relation. But then another issue here is that it is all interconnected if you see. So new bonds are coming in, more cash is required by the government. So just like the US government keeps printing money. How are they printing money? They are releasing new bonds, say to US, to Fed and even China and other countries including India. So we hold their treasury bonds or their T-bills or their bonds, US treasury bills which we say. So these are all types of bonds based on their duration and returns. So if we are buying their bonds means a person who is releasing the bonds is sucking the liquidity. So I am investing their 1000 rupees there, so that 1000 rupees won't be available for me to invest in stocks. So the money which was supposed to be invested in stocks is not invested there, and this is leading to reduced demand for stock market and money goes to the bond market. So this is the relationship between the bonds, stock market, interest rate, your home loan rates, etc. So another important thing which you would have noticed here is that the bond yield is having an inverse relationship with the bond value. The bond value reduces means the bond yield increases because your initial investment is lesser and you are getting the same return, means you are getting effectively a higher return. So From this session, I think you are clear on what is bond yield, what is face value of a bond, what is the coupon rate, how the bond yields are related to the interest rates of the central bank. Well, in that case, how it is related to your FD returns, your home loan interest rates, and how this will all impact the liquidity in the market as far as investments to stock market is also concerned. Hope this session was clear. If you have any comments, please feel free to comment in the comment box, and if you want me to do any such conceptual topics, please do let me know in the comment section. Our channel is formed, as you all are aware, to educate people on the core value investing principle, the fundamentals behind investing in stocks, mutual funds, bonds, even commodities, and understanding geopolitics and understanding the concepts behind all these things, which will help you in making a right decision in doing investments. Though I am not a SEBI registered investment advisor, I try to bring in concepts and value investing principles which I read from various books you can see on the behind, and also from various media and write-ups and notes I read, and from people I interact with, the like-minded investors, and I try to bring in that values into my channel and try to educate you on those concepts so that you make right decision before investing and continue your wealth journey. See you in next video. Till then, happy investing.